Hello everyone, here we are, FOMC day. What else is there to talk about? The big event will be the announcement of the FOMC's decision on whether to begin tapering off its monthly purchases of $85 billion in bonds, $45 billion in treasuries, $40 billion in mortgage-backed securities. And if they do decide to taper off, how much to cut back of each kind? According to a Bloomberg survey of 61 economists, 30% of the respondents expect no change, that they're not going to start tapering off. But of the 70% who do expect a change, only 2 people, or 5%, expect just a $5 billion cut. About half of them expect a $10 billion cut. A quarter expect $15 billion, and the rest expect $20 billion or more. In other words, while about a third of the market wouldn't be surprised to see the FOMC delay the start of tapering, if they do start tapering this month, then they're expected to start cutting by $10 billion to $15 billion. The largest forecast for the cut is $25 billion. Well, there was one lonely guy who was forecasting an increase in the purchases, but I think that was just probably a mistake. The question is not only how much overall to cut back, but also the mix. Mortgage-backed security purchases directly fund the mortgage market and therefore help the housing market, and so are thought to do more for the economy than treasury purchases, which is why some people argue that mortgage-backed security purchases should be cut back less than treasuries. On the other hand, some others think the Fed should cut both proportionally so as to keep things simple and ensure that they communicate their intentions smoothly to the market to avoid the dreaded confusion in the marketplace. Personally, I would think a cut of $5 billion in each would be within the range of market estimates and wouldn't have that much of an effect on the market. In fact, it could give a rise to a small relief rally, meaning yields down, dollar down, that they didn't cut by more. A $15 billion cut, comprised of $10 billion treasuries, $5 billion mortgage-backed securities, might be seen as at the top of the expected range, and it could send U.S. interest rates and the dollar up modestly, if anything. A $20 billion reduction would probably be seen as aggressive and would be likely to push U.S. rates up and the dollar up sharply, in my view. While I expect that no change would result in a relief rally, as I just mentioned, among the 70% of investors who expect some tapering to begin today. My personal expectation is for a $10 billion cut, given the Fed's desire not to upset the markets by moving too quickly. That would imply a slightly weaker dollar on the news, but nothing that major. Of course, the market's reaction is likely to be colored by the statement that accompanies the announcement and by the comments that Chairman Bernanke makes in the press conference following the meeting. The market will parse those words with extraordinary care to predict how the Fed intends to proceed from here. In addition to the statement, the market will keep an eye on the new economic projections from the FOMC members concerning interest rates, inflation, growth, and especially unemployment. The last projections, made in June, were for the unemployment rate to be 6.5% to 6.8% next year. That falls below the 7% barrier that Chairman Bernanke set for eliminating the bond purchases, but not falling below the 6.5% trigger for raising rates until 2015. So let's all keep glued to our screens and wait for the big headline this evening. This is Marshall Giller, head of Global FX Strategy at IronFX, wishing you solid trading.